Welcome to another edition of Cattle Call. I'm Susan Littlefield here on the Rural Radio Network. We're going to talk about the fact that we've got a handful of deliveries that have happened this week. We've looked at maybe a correction day already taking place this week. And let's talk about fear versus greed. We'll talk more about that part as we continue on the show. Brad Kooima joins us. He is with Kooima Kooima Varilek out of Sioux Center, Iowa. Glad to see that you made it out of the grain tractor and back into the office.
Yeah, well, thanks for having me on. I'm not gonna lie, I do really enjoy helping out with harvest this time of year. My son and I farm. Well, I say my son and I. He does almost all the heavy lifting, and I've become the hired man, which is exactly what I want. I'm very thankful for that. So he even let me run the combine for a little while Saturday morning. Anyway, no, it's good, and we got the variable crop, but a pretty nice crop where we are now, and beautiful weather to harvest it. So it's been fun. You mentioned let's see, where do we start? We mentioned, I think, the deliveries. I guess we could go ahead and start on that if you want. It doesn't strike me that it seemed to make a great deal of economic sense from a basis standpoint. Typically, deliveries happen when the futures are carrying a $2 or maybe $3 premium to the cash. In other words, it's the producer's best bid is to go ahead and use the futures market as a choice, which is what it's designed for. Right now, it seems like we're basically at par with cash, but whatever. Okay, so we had 10 loads a couple of days ago, got retendered twice and then reclaimed, and we had 10 loads put out again last night. So what happened initially is it hurt the October cattle a little bit because, you know, if you're long, you don't want to catch delivery, you can't get them dead on time, so you retender, you get out, and that liquidation of the longs, just creates selling. It was interesting to me today that, in fact, it was the opposite was true. October was the strongest all day. It never gave up. It was higher all day. A lot of times during the day, that was the only month that was higher. So it looks like the traders saying, whatever, somebody can deliver 10 loads if they want to. We're not going to get too caught up in it. So October used to be the month where we get a lot of deliveries because typically that's the way the basis used to be. But anymore, with the way the market is traded either at or below, futures at or below the cash, we haven't had a lot of deliveries for quite some time.
How overbought is the market at this point?
Well, I feel like a broken record. I think we went on to, 2-3 weeks in a row, right? I go like, well, stochastics are blah, blah, blah. And we were overbought for nearly a month, 3 or 4 weeks. This is a math problem, right? It's a statistical thing where it's a number. If it's above 80, it's overbought. It basically is just a statement of that the market's gone up or down. That would be oversold faster than what's normal. Okay. So the market's kind of you've been thinking here, well, surely we'll get a little correction. I mean, the market is action, reaction, right? And so a little bit, yesterday was a big break. It seemed like all the commodities were in on it yesterday, corn, beans, cattle, and hogs. And now the second day for the back months of correction. But what I thought was, so yes, I think part of this thing is certainly strictly a futures correction of taking a breather, longs taking some money, that sort of thing. But what's interesting to me is the way the spreads handled it the last 2 days. Ideally, you would like a bull market to have bull spreads. A bull spread would be when the front month is stronger than the next one, and the next one, and the next one, and the next one. Okay. Well, look at today. October up 32, D's up 7, Feb's up 42, down 42 rather, and June's down 72. So, if you're going to have a correction and have the structure of the spreads like that, that's, if you're bullish anyway, that's exactly the way you'd want to have it done. So, boring stuff to talk about, but it is what it is. We get overbought and the market finally breaks a little bit. So maybe it's over. Maybe 2-day dip is all we get.
I'm excited to hear your answers to this next discussion, and that's fear and greed. What we see within this cattle industry.
Well, it's an interesting topic because I think back when there was a pit, I thought that if one could somehow try to develop, at least at times, an understanding of that concept, that a lot of traders are impelled to do what they do based on either fear, like say a hedger, and how a hedger reacts to an algorithm that suddenly sells hundreds of contracts, which triggers a level of selling because we're afraid and we wished we would have got our stuff hedged. So we hedge, there's that element of the market. I'm convinced of that. And I think that that's an issue that is created by that, the high frequency trader, the algorithm, the market that seems to prey on that emotion. The other part of that deal, I'll reference with 125,000 kill today and yesterday. And that is about because you have a packer that's making money. Conservatively somewhere around 50. It's probably way, way, way more than this, probably triple that in my opinion. But and when a packer's making money, he's greedy too, just like you and I are. And so he kills big. Big kill is good for cattle, right? We've talked about this weight issue till we're sick of talking about it, I think. But we need to kill off some weight and having bigger slaughter. And that helps offset last week's slaughter where you had a couple plants dark on Monday. You only had 106 kill on Friday. So I'm really happy to see the kill level this week. I think that's a good sign. The packer's willing to take on inventory. So he's either got meat sold or he just likes to make money, and he's going to kill a few more extra ones.
So then, can I ask, is cash going to be at least steady knowing the struggles we've had this week? Maybe.
Usually I have a pretty strong opinion on the cash. I thought for the last 3 or 4 weeks we were going to put money on it. This week I have I don't know if anybody is close enough to the knife that we can gain some leverage on them. It feels like they've all got a little bit of inventory. And then, you got a couple packers that are bragging that they got a lot of inventory already formula priced or contracted to them, captive supply either way for the first part of November. But so I feel like steady is probably about it. Now, there was some indications yesterday in Texas that the bids were about steady already on a Tuesday, which I thought was a great sign. If nobody's noticed, we've lost our premium in the north, right? And we've been premium in the south for a long time, and basically almost lost all of it last week. Now, there was a little bit of 188, but for the most part, 187 was what we got in the north, and that's also what they got in the south. So I think, Susan, that the perception is that there's a few cattle around here that would be very normal seasonally for us to have a farmer feeder with long-fed calves. They're ready in October. I don't see that there's a unusual amount of cattle here. In fact, I think that there's an unusual less amount of cattle than normally this time of year in the north. We've talked about that before, about as the north goes, so goes the market. So I don't know. It just feels to me like nobody needs enough cattle. Let's call it steady. Let's hope I'm wrong, that we're a little bit better than steady.
All right. Well, I appreciate your time to break down this week's cattle market. What's the best way for folks to get a hold of you guys?
The phone is 712-722-0023, or check us out on kkvtrading.com.
Brad Kooima joining us once again this week. A quick reminder, commodity futures and options do involve a substantial risk of loss, not suitable to all investors. And that's this week's Cattle Call on the Rural Radio Network.